There is a company you have never bought a product from. You have never signed a contract with them. You have never chosen to give them your money. And yet, as of December 2025, they manage $14 trillion in assets. That is more than the entire annual economic output of China. They are the largest shareholder in Apple, the largest shareholder in Microsoft, the largest shareholder in ExxonMobil, JPMorgan, and Bank of America. They own a piece of the company that services your mortgage, a piece of the fund that holds your pension, a piece of the landlord's company that owns the building you live in. The company is called BlackRock. Most people have never heard of them. And the question nobody is asking is this: if one company sits at the center of almost every major financial decision affecting ordinary people, who exactly are they working for? Think about the last time you made a financial decision, opened a savings account, took out a car loan, contributed to a retirement plan at work. You probably dealt with a bank, or a pension fund, or an insurance company. Here is what you were not told. The bank, the pension fund, and the insurance company, they all have the same landlord. Not literally, but financially, they are all connected to BlackRock. BlackRock's software, called Aladdin, currently processes risk calculations for approximately $25 trillion in assets. That is not $25 trillion that BlackRock owns. That is $25 trillion that the financial world has trusted BlackRock to analyze. Pension funds, central banks, insurance companies that cover your house and your health. They all run their portfolios through the same system, built by the same company, operated by the same team. By the end of this video, you will understand something that most people, including most people who work inside the financial system, never fully articulate. BlackRock is not just a big investment firm. It is the closest thing to a financial operating system the world has ever built, and you never got to vote on whether it should exist. The official story about BlackRock is a clean one. It goes like this. In 1988, Lary, Fink, and 7 partners started a small bond shop inside the Blackstone Group. Initial funding, a $5 million credit line. Initial staff, 8 people in a single New York office. Fink had recently lost $90 million at First Boston by miscalculating interest rate risk on mortgage securities. That failure became an obsession. He wanted to build a firm where risk was the product, not returns. Risk. The idea worked. By 1989, 12 months after launch, assets under management had quadrupled to $2.7 billion. The firm grew. They built better risk models. Institutions started trusting them with serious money. In 1999, BlackRock went public. In 2009, they acquired Barclays Global Investors, and with it, the iShares ETF business, the largest exchange-traded fund platform in the world. That acquisition was worth $13.5 billion. It was the deal that changed everything, because with iShares, BlackRock did not just manage money. They became the infrastructure through which ordinary people invest. Every time someone buys a low-cost index fund, every employer-sponsored 401k plan, every passive retirement account, a significant portion flows through BlackRock. The conventional narrative calls this democratization, cheap access to markets for ordinary savers, and in a narrow technical sense, that is true. The fees are low, the access is real, the diversification is genuine. But here is where the story gets complicated. Think about a polling company, not a company that votes, a company that counts votes. Now, imagine that same company also happens to advise every major political party, runs the software that tabulates the results, and charges a small fee each time a ballot is processed. That company does not need to rig anything. It does not need to tell anyone how to vote. It just needs to be the only company anyone calls when the results matter. That is approximately what BlackRock built. Here is the specific mechanism. When ordinary people invest in index funds, those funds buy shares in every major company in the index. But the index fund manager holds the voting rights, not you. BlackRock, along with Vanguard and State Street, are collectively the largest shareholder in approximately 88% of S&P 500 companies. These 3 firms cast roughly 1/4 of all votes at S&P 500 shareholder meetings. To put that in human terms, BlackRock alone holds a 6.7% stake in Apple, worth approximately $200 billion. a 7.3% stake in Nvidia, roughly 7% of Microsoft. These are not trivial positions. A 5% shareholder gets meetings with the CEO. A 7% shareholder shapes strategy. And here is where the housing myth is worth addressing directly. For several years, a viral narrative spread online. BlackRock was buying up houses, outbidding families, turning neighborhoods into rental portfolios. That story was almost entirely wrong. The company buying single-family homes at scale was largely Invitation Homes, backed by Blackstone. A different company, one letter different in the name. BlackRock's own spokesman stated clearly in January 2026, "We don't buy single-family homes." But here is the uncomfortable truth. They didn't need to. When BlackRock holds major stakes in every large bank that writes mortgages, when their Aladdin software runs the risk models that determine what interest rates those banks charge, when their index funds are the largest shareholders in every major home builder and mortgage servicer in America, you don't need to own the house. You own the system that prices the house. This raises an even more uncomfortable question. If the Aladdin system is processing $25 trillion and advising the pension funds, the insurance companies, and the central banks that touch almost every financial decision in your life, who is watching the people who built the system? In March 2020, the coronavirus pandemic began collapsing the corporate bond market. Companies could not borrow. The entire credit system was seizing. The Federal Reserve decided to act. For the first time in American history, it announced it would buy corporate bonds directly, propping up private companies with public money. The Federal Reserve hired BlackRock to run the program, not through a competitive bidding process, through a no-bid contract. The contract, eventually worth up to $750 billion, gave BlackRock the authority to purchase corporate bonds on behalf of the United States Central Bank. Under the arrangement, as Bloomberg reported at the time, BlackRock could technically buy its own funds on behalf of the Fed, using money backed by the American taxpayer. This was not new. In 2008, during the Bear Stearns collapse, the Federal Reserve hired BlackRock to manage a $30 billion portfolio of toxic mortgage assets. Again, no competitive bid. Congressional records show that over the following decade, more than 100 individuals passed through the revolving door between BlackRock and the federal government. BlackRock currently spends over $2 million per year on federal lobbying. And yet, as of 2024, BlackRock had still avoided designation as a systemically important financial institution, the regulatory category that would subject it to stricter government oversight. The firms that are too big to fail get that label. BlackRock managed to be essential to everything without receiving the label that comes with scrutiny. This was not an accident. This was a choice. The question is, who made it? Think about the asymmetry here. When the corporate bond market froze in 2020, ordinary workers were also freezing. Unemployment hit 14.7% in April 2020, the fastest economic collapse in American history. Those workers did not get a no-bid government contract. They got a $1,200 stimulus check. One time, the firm that already managed $7 trillion in client assets got a contract to manage hundreds of billions more, with the implicit guarantee that if anything went wrong, the Federal Reserve was standing behind the trade. That is the system working exactly as designed, not for you, for the people who built the infrastructure that everyone else has to use. Lary Fink did not set out to build a shadow government. In 1986, he was a 33-year-old bond trader at First Boston, considered one of the best on Wall Street. He pioneered the mortgage-backed securities market, the same instruments that would later blow up the global economy. Then, he miscalculated an interest rate move and lost $90 million in a single quarter. He was pushed out. That loss was the founding condition of everything that followed. Fink's obsession became risk, not how to make money, how to know precisely how much risk you are taking. He approached Blackstone's Pete Peterson in 1988 with a proposition: let me build a risk-first asset manager. Peterson gave him $5 million in exchange for half the business. Within 4 years, the risk obsession had become a software system. By 1999, BlackRock was licensing Aladdin to outside clients, not just managing money, charging other institutions to see through Fink's lens. In 2009, They bought Barclays Global Investors for $13.5 billion, gaining iShares in the passive investing pipeline into every retirement account in America. The publicly stated reason for that acquisition: to become the world's largest asset manager. The actual effect: to position BlackRock as the mandatory infrastructure between ordinary savers and the market. You want a cheap index fund? This is the company. This is the platform. These are the voting rights you are handing over. Nobody made that explicit. It was simply the logical outcome of building a better mousetrap in a market with no competition rules. By 2012, Fink began writing annual letters to the CEOs of every major company BlackRock invested in, addressed personally, on BlackRock letterhead, laying out what Fink expected. In 2018, that letter catalyzed the entire ESG movement. Fink declared that climate risk was investment risk. Every major corporation adjusted its public position accordingly, not because a government mandated it, because the largest shareholder in almost every public company sent a letter. One man, one letter, 8 pages. Corporate America complied. In 2022, Republican state politicians decided they had had enough. Texas, Florida, Missouri, and 16 other states began pulling pension funds out of BlackRock, citing the ESG agenda as politically motivated. Texas passed legislation in 2021 prohibiting state contracts with firms that boycott energy companies. BlackRock was the primary target. The result? Texas state pension funds moved approximately $8.5 billion away from BlackRock-managed products by 2023. That sounds significant. BlackRock's total AUM at the time was $9 trillion. The Texas pullout represented less than 0.1% of their assets under management. The resistance exposed something important. Even people who understood the problem, who had the political will, the public mandate, and the legal authority to act, found that the system was too embedded to meaningfully exit. Where did the Texas pension money go? Into other index funds, managed by Vanguard and State Street, the other two members of the same Big Three. By 2023, Fink had dropped the term ESG entirely, called it weaponized and politicized, stopped using it in letters. The political pressure worked, in the sense that the language changed, the voting power did not change, the asset base did not change, the Aladdin contracts did not change, the Federal Reserve relationship did not change. The only thing that changed was the vocabulary. That is what successful resistance to this system looks like, a rebrand. At the beginning of this video, we said there is a company you have never bought a product from. That is still true, but it is also the wrong frame. BlackRock's clients are not you. Their clients are the pension fund that manages your retirement, the insurance company that covers your car, the sovereign wealth fund of a country you will never visit. You are not the customer. You are the underlying asset. Your monthly pension contribution flows upward into a fund manager who runs their portfolio through Aladdin and holds shares in every public company that shapes the price of your groceries, your rent, your health care, and your interest rate. At every step of that chain, BlackRock collects a fee. BlackRock casts a vote. BlackRock runs the risk model. As of December 2025, BlackRock manages $14 trillion. Aladdin touches $25 trillion. That is roughly 1/5 of all professionally managed money on Earth running through the infrastructure of a single private company. A company that was hired by the Federal Reserve without competitive bidding. A company that passed 100 of its employees through the revolving door of government without ever being declared systemically important. A company that built a software system so essential that Apple, Microsoft, and Google all use it to manage their own financial risk. The machine that prices your world was built by a man who lost $90 million and decided the problem was that no one could see the risk clearly enough. He was right. He built the clearest view of risk in the history of finance, and then he charged everyone else to look through his window. Nobody reports on this as corruption, not because it is hidden, because it is legal, because it is, in fact, how the system was designed to work. The firms that become essential are allowed to stay essential. BlackRock does not own your life. It owns the infrastructure your life runs on. The distinction matters less than you think.